We've got Rajan Sethuraman joining in on the show right now, the CEO at LatentView Analytics on the show. Rajan, hi, morning. Great to have you today on ET Now. Help us understand what are the demand trends that you're seeing across your segments, your technology, industrials, as well as financials.
Thanks for having me on the show. On the demand front, we see that it's still a little slow, especially in the financial services sector and in retail. Industrials, there is a little bit of action. We have, in fact, had some good conversations and some closures as well. On the technology front, as I had mentioned in my earlier interaction, the progress continues to be a bit incremental. We are likely to have 1-2 larger deal closures, but we are still waiting for those signatures. So in general, I see that the first half of the year has been a bit sluggish, and there is some expectation that there'll be a pickup in the second half of the year.
What is stopping you from using your cash on the book? I mean, you have a sizable kitty, or war chest. If you think that growth is not that great, what is stopping you from acquiring growth?
No, nothing is stopping us actually. And in fact, we are in the process of evaluating several acquisition opportunities that are there on the table. Some of them have progressed as well, right, in the last few months. We are not close to signing anything at this point in time, but there is an evaluation process underway at this point in time. We will probably have more updates, right, once the quarter is over, right, and we are able to share the results.
Acquiring, I mean, in terms of a geographical presence or in terms of a customer base?
So we are actually looking at some specific niche areas. We are looking at data engineering. We are looking at supply chain analytics. We are looking at specific areas like revenue growth management and pricing analytics, for example. At this point in time, we are open to opportunities that have a customer base either in the US or in Europe, or they have enough potential, right, for customer opportunities in those geographies. So an ideal combination would be something that marries the technical, the functional, as well as the geographical priorities that we have.
Right. You know, last time you had highlighted that deal decision making is actually slow. Are you seeing any pickup over there?
No, that was what I was mentioning, right, in response to your earlier question. We have quite a few opportunities that have gotten into the pipeline. In the technology sector, for example, our experience has been in the past that deals can close anywhere from 2 to 3 months kind of a time frame. I'm seeing that it is almost double at this point in time. I mean, easily taking 4 to 6 months. That is one aspect. The second aspect is that in general, the conversations are about slightly smaller initiatives at this time, and organizations are unwilling to start any big new initiatives. So that is also taking more time, right, to shape those opportunities. So combination of that means that the sales cycles have gotten longer, and that's been the case for the last 9 months or so. We are expecting that there will be some movement, especially in terms of utilization of budgets towards the last quarter of the year. For many of our clients, the calendar year is their fiscal. So we're expecting some closures so that they also get a move ahead, right, in terms of next year's planning on what they intend to do.
Looking at exactly a year ago, revenue 132, margins 28, profit 37. Your revenue has gone up, but margins from 28% have gone to 19%. So in an expansionary mode, normally operating leverage should kick in. What we've seen is almost like a 900 bips or 9% drop in margins. Why is that?
So yeah, it's a combination of factors. One is that we have significantly stepped up on the investments that we need to make in the front end, more so in underpenetrated markets, with respect to, for example, retail and BFSI in the US and Europe in general as a geography. So a year back, we had just one person in the market in Europe. Today, we have 10 people, plus we have a few advisors on board as well. So there's a lot of front-ending of the investments that have happened on account of this. That coupled with the general macroeconomic scenario and the sluggishness means that the margin has been impacted in the last couple of quarters. We are expecting that these investments will start panning out for us in the next few quarters, and the margin profile will come back to the earlier 25-26% range right over the period of time.
So when will the benefits of this kick in? I mean, in next 2-3 quarters, will you go back to margin range of 29-30%?
29-30% was never our guidance. I think that is also on the back of what happened during the pandemic. The margin range that we have indicated in the past is between 25 to 28%. We're expecting that we'll start getting closer to that trajectory in the next 2-3 quarters time.
Could challenge your optimism? I mean, could it be deal delay? Could it be US macro? What else? Or could it be AI?
It could be all of those things. I mean, obviously, the investments that we have made, for them to fructify it, there is also the need for the market to be responsive. At this point in time, as I said earlier, there is in general delay in decision making plus reluctance to take on new large deals. The good news for us is that all the work that we have been doing, that has been renewed, and we have been executing that work, and we have seen incremental growth as well. So we grew at about 4.7% quarter on quarter last year. We are expecting that a similar trajectory can continue, right, in the next 1-2 quarters, even if there isn't any big pickup from a new deal signing perspective. What we are, however, hoping for is that we can get back to a even higher quarter-on-quarter growth rate on the back of some of the opportunities that are in the pipeline that could potentially get to closure, right, in the next few months itself. So that's what we are hoping for. But all those factors that you mentioned, right, I mean, if there is a general dampness in the scenario, if there are other extraneous factors that come into play, they all could act as dampeners.
How would you map the competitive landscape for us? I mean, who would you say is your closest competitor and what is happening there in terms of the competition?
So, I mean, our competition comes from 3 broad areas. One is all the other pure play analytics firms like us, which are many instances India-based, but are looking at US and European markets. And I'm talking about companies like Mu Sigma and Fractal, for example, right? Then we have the analytics practices of larger IT companies and systems integrators, like an Accenture or Infosys, TCS. They all have practices, analytics practices as well. And finally, if it is a very well-defined problem, you also will have commercial off-the-shelf software and products available, right, which can solve with the analytical rigor that is required. So we see competition from all of them. Our advantage is our ability to marry the business, technology, and the math skills and expertise to go after fuzzy problems, which aren't very well defined, which need a good amount of consulting and discovery upfront for us to even define the problem and help shape the opportunity for the client. That is where we excel. And we believe that as the analytics maturity of organizations increase, some of the problems that they will go after will become more and more complex and fuzzier. And that's where we believe we will bring a lot of differentiation to the table.
Okay, thanks so much for joining in and sharing with us that view. That's LatentView. The stock is under a bit of pressure in trade in tandem with the rest of the market.